The stock market drops, headlines scream panic, and investors start asking the same question: should I sell everything? But history shows something surprising. Some of the best investing opportunities happen when markets fall. Today, we read breaking down the strategies smart investors use when the market goes down and how downturns can actually create long-term opportunities. First, it's important to understand that market drops are normal. The stock market has gone through crashes, corrections, and recessions for over a century. Major indexes like the S&P 500 have experienced dozens of corrections. Yet over the long run, they have historically trended upward. Markets typically fall for a few main reasons: rising interest rates, economic slowdown, fears geopolitical uncertainty, investor panic, and profit-taking when uncertainty rises. Investors often sell quickly, which pushes prices down. But long-term investors often see these moments very differently. One of the biggest mistakes investors make during a market drop is panic selling. When prices fall, emotions take over. Fear makes people sell investments at the worst possible time. Legendary investor Warren Buffett once famously said, "Be fearful when others are greedy, and greedy when others are fearful." In other words, the moments when investors panic are often the moments when opportunities begin to appear. Selling during a crash locks in losses, but historically, markets have always recovered over time. When markets drop, strong companies often fall along with weaker ones. That can create opportunities. Investors begin looking for companies with strong revenue growth, solid balance sheets, long-term industry leadership, for example. Companies like Nvidia, Apple Inc., and Amazon.com have all experienced major pullbacks in the past. Yet long-term investors who bought during downturns often saw significant gains when the market recovered. The key is focusing on quality companies, not just cheap prices. Another powerful strategy during market downturns is called dollar-cost averaging. Instead of trying to perfectly time the market, investors buy investments gradually over time. For example, instead of investing $10,000 all at once, an investor might invest $1,000 per month. When prices drop, that same amount of money buys more shares. When prices rise again, those shares can grow in value. This approach helps remove emotion from investing and takes advantage of market volatility. Short-term market movements can feel dramatic, but long-term investors focus on years and decades, not days or weeks. Historically, the Dow Jones Industrial Average, the Nasdaq Composite, and the S&P 500 have all recovered from crashes and gone on to reach new highs. Market downturns can feel scary in the moment, but they are also a normal part of the investing cycle. The truth is, market drops test investors, but they also separate emotional investors from strategic ones. While many people panic, experienced investors often prepare for the next opportunity. Like and subscribe to this channel for more videos like this.